Africa is full of opportunity, but turning that potential into real investment isn't just about money. It's about markets. So this is Insights from Africa. I'm Bronwyn Seaborn, and on this episode, we take a look at how African capital markets are unlocking investment, boosting liquidity, and funding the continent's future. Africa's capital markets sit at a pivotal point. The continent faces a significant financing gap for infrastructure, energy, and growth. And yet, global capital is abundant. And so the challenge appears to be less about availability and more about alignment, matching global pools of capital with African opportunities in a way that is scalable, bankable, and sustainable. That brings into focus the role of institutions that sit at the intersection of global markets and African investment. And so to unpack this in more detail, I'm joined by Bulelwa Tetiana, the Head of Strategy Enablement for Global Markets within Corporate and Investment Banking at Standard Bank. Bulelwa, thanks so much for your time today. So right out the gate, I'm going to ask the big question. From your vantage point, where does Africa's financing gap actually bite the hardest? Is it a shortage of bankable projects? Is it a shortage of capital? Or is it just this mismatch between global capital and local risk structures?
Good afternoon, Bronwyn, and thank you for having me. Yes, I actually do think it is a combination of everything that you have just mentioned. It is a lack of bankable projects. It is a lack of capital flows onto the continent. And might I add, it is also this conundrum we're faced with on the continent, which is the credit rating of the continent. It is something that we're grappling with on the continent. There is a combination of a perception risk that really makes the Africa asset or the Africa risk very expensive to offshore investors. But, as Standard Bank, it is something that we are looking closely into, and we really want to contribute positively in contributing in closing this financial gap for the financing gap for the continent. So it is something that we believe that we best positioned as the biggest bank on the continent to really partner with the economies that we are present in on the continent to close this financing gap.
I'm going to get into the risk in a little minute, but first I want to talk about this need or the increasing talk that there is around about mobilizing global capital at scale for Africa. In practical terms, though, what differentiates scalable capital mobilization really from what we are seeing now, which is the smaller kind of deal-by-deal transactions?
Yeah, so really what differentiates mobilizing capital at scale to deal-by-deal financing is really what, if you think about it, we spoke just now about this financing gap. Depending on what source you're using, one would say it's sitting at about, anywhere between $130 billion to $180 billion. And that is a huge amount that we need to close as a gap. So what really differentiates this mobilization of capital at scale is that we need to close such a significant gap in a short period of time, because the target is 2030. That's the target that we've set out as a continent to reach the sustainable goals for the continent. So we've got very short period of time to close such a big gap. So therefore, what we have seen in the past is traditionally in the past, there's been financing that was at a very small scale, which was deal by deal, that was done typically by DFIs, which was in the past very expensive and not sustainable for the continent, which is why we're seeing that there's high debt levels on the continent to date, because financing was done at a deal by deal level and it was at very expensive rates. So what we're seeing with this mobilization at scale is that we're able to reduce the cost of capital because we're looking at partnering with foreign investors where we create structures that are actually good structures that are able to de-risk some of these investments for foreign investors. There's also opportunities for private capital to partner with public sector in order to finance infrastructural projects as well. So that's where we play a role as Standard Bank, because we have the right presence across the continent in 18 countries, more than 18 countries, in fact, across the continent. We have reach in the offshore space because we have presence in the Gulf, in Europe, in America, where we can bring in that global capital onto the continent and actually create innovative structures that de-risk the Africa risk in order to actually make it sustainable for the continent to get capital onto the continent for its infrastructural development.
It's exactly that. You highlight this high cost of capital and the link that is being made between that and risk then moving forward, and Standard Bank playing that role. Would you agree that it's also because most global investors see Africa as this one high-risk block rather than various different markets with very different profiles, and that really impacting risk and so impacting prices as well? How do we go about addressing that? I'm sure Standard Bank, as you mentioned, they're in many territories in Africa, and so intricately linked with making sense of the continent for the globe as well.
Spot on, Bronwyn. Africa is a continent. It's not a country. It's got 54 countries. And this is why actually platforms that we create in Standard Bank, such as the African Markets Conference, are so important, where we bring in investors, domestic and offshore investors, and we bring them in to have conversations with our policymakers in order to understand the Africa risk more intricately, because there is a perception risk, like I mentioned earlier on. And there is this misconception that there is one Africa risk, whereas there's different portfolios within the continent. And so it is very critical, therefore, to understand what each country represents. We understand that there's geopolitical risk on the continent. We understand that in some of our countries, there's instability in fiscal and monetary policy regimes. And so there is, therefore, a role that policymakers play in order to actually lower that perception risk that exists today for offshore investors. And so that's why then there's platforms that we create as a bank, such as this conference I've mentioned, which is the African Markets Conference, are so critical, so that there's engagement with policymakers, and policymakers get to understand why sometimes there's hesitancy from offshore investors in bringing in the capital onto the continent, so that policymakers are able, therefore, to stabilize policy. We don't have this this historical problem on the continent that when one president exits, policy changes, that we create an environment that that investors are confident that policy is stable from one regime to the next. There's also currency risk that we faced with on the continent. So we also, therefore, need to have structural reform on the continent that creates stability in our currencies, so that investors have confidence that they can take their capital out of the continent when they need to take it out, so that they don't feel that their capital can be trapped on the continent when they need to take it out, right? So it's therefore important that as commercial banks, we play that role as well in educating, investors. And of course, all of this also therefore talks to the development of our capital markets. So commercial banks play a role in that as well, in partnering sovereigns in developing our capital markets. But this, for me, does not excuse the ratings agencies as well. The ratings agencies also have a role to play. Ratings agencies need to realize that they also are responsible and to make sure that, the ratings really do reflect the right risk that is on the continent.
Yeah. Absolutely. We so often find with the ratings agencies that countries that are really rather far apart are used to assess risk for other territories and regions, and that becoming quite unfair. But that's a whole other conversation we won't get into today. But you did highlight that, there's this offshore capital coming in, the importance of local capital development as well. And then there's this question of capital moving within the continent as well. We of course have the Africa Continental Free Trade Area standing as a hope really that this will happen. But as we sit today, capital markets here in Africa still remaining quite fragmented. What practical steps do you see needed to be taken in order for there to be this deeper cross-border investment and intra-African capital flows really to take place?
That's actually, I think, a good question, because there's a lot of conversations that I have with colleagues where, there's a growing, I would say, cynicism sometimes with some people saying, when are we starting to see results with the Africa Free Continental Trade Area Agreement? And my view is simply this. I feel that we all have a role to play. And I don't think that AfCFTA should be seen as this thing that will just unlock everything for the capital flows to, in the continent. So I see, a few things that do need to happen. Firstly, I do think that cross-border regulations are important. And those, yes, they will start with some of the work that's already been done through the AfCFTA. However, there needs to be a broader engagement and agreement within the different sovereigns as well, in terms of trying to make sure that the regulation is regulation that makes sense to boost flows across the different countries. Right now, as we stand on the continent, the biggest capital flows on the continent are between three countries, really. That's South Africa, Nigeria, and Kenya. We don't see a lot of flows across other countries on the continent. And so we need to be much more deliberate as a continent to really boost the flows from other countries. Remittance flows are actually a good source of capital as well for the continent. I've read a stat that says that remittances on the continent are currently sitting at almost $100 billion as of 2024. That's an astonishing number. Imagine what $100 billion can do for the continent. And that was just over 50 billion 14 years ago. So imagine what we can do today with that number. So if we talk remittances in a bit more detail, as an example, remittances can be boosted by creating platforms to enable the flow of remittances across the continent, right? And so that actually has nothing to do with AfCFTA, like I said. So we should not look at AfCFTA as the answer to everything that we need for capital flows for the continent. So we need to look at how can we actually look at creating platforms, look at data as well as an enabler in creating platforms that will make sure that payments are actually happening on the continent in a seamless manner, and we settle payments on, timelessly across the continent. AI is something that we need to look at very closely on the continent. We're usually a leader on the continent when we talk about technological advancement. We a leader even better than the USs of the world sometimes when it comes to technological advancement. So we need to look at those things, at how we can do that better and partner with the sovereigns to actually think about solutions that will enable us as a continent to really boost the capital flow across each of the jurisdictions on the continent.
Well, there's certainly a lot of hope for the avenues the African continent can go down and explore to boost capital markets. But for now, let's leave our conversation there. Bulelwa Tetiana is the Head of Strategy Enablement for Global Markets within Corporate and Investment Banking at Standard Bank. After the break, we hear from Africa's largest stock exchange and find out how it's shaping the continent's capital markets. So don't go anywhere.